Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for December 6, 2014. We have a market that is in bullish normal conditions. On an annual basis with weekly RSI 14, we're at the high end of neutral with a reading of 68 out of 100. The 10-day NDX, looking at the short-term market condition, is overbought at 93 out of 100. The market mosaic shows price relative to the 200-day moving average at 7.68% white bullish. Slope of the 50 has improved to green bullish at 0.43. ADX 14 remains strongly trending up at 35.8. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. The current reading is at 1.07, so we are into risk on conditions, meaning that riskier assets are favored to be held. We take that score of 1.07, compare it to the last 5,000 trading days, and find the standard deviation from average. That gives us the risk z-score right now is 0.76. You can see a 90-day histogram of that indicator here. We're still well above the zero line, so risk on is favored. We just completed an extraordinary swing trade move from 25 to 40 in XIV in a matter of about 30 days. And we're holding steady right here, so that's really to be considered a favorable condition until proven otherwise. We're going to respect our stops, but the failure to fail further is information. You can see the holdings of the blended monthly rebalancing. The next reevaluation is due on or about 1 January. These are the current holdings given the price closing on Friday. ETF2, theoretical exposure, and the model portfolio are both at 60% exposed. Just a quick look at the ETF 13 and 32 portfolios. See about evenly split between buy and sell, with strength favoring the U.S., large caps, and technology. Brazil continues to lag along with Latin American energy. In the ETF Max, we're looking at about 11 or 1,200 ETFs, and these are the ones that rise to the top using that blended monthly rebalancing lens. You can see the domination by healthcare and biotech, pharmaceuticals. India still is holding on, but we're seeing some weakness here in the global carbon, white and green. U.S. deflation, green and white. And Vanguard consumer staples, green and white, is favorable for the U.S. Large caps. So that strength should continue. In the S&P 500, this reflects the top 40 or so, and using that BMR lens, but also shows the sector spider that they are members of. So Vertex is continuing to march along here. Yahoo, interestingly enough, moving to the top, along with Southwest Airlines taking advantage of the fall in the price of oil. So market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are price levels that have held as support in the past and should continue to hold, and would be price targets if they get violated on the way down. You can see the sine wave here is the slope value of the 30-period regression line, and the blue circles are reflecting where that has crossed the zero line and turned positive, and also where it has reached local minimums. Now, the reading right now is at about 0.38, and that's still very, very positive. It looks like it's failing a little bit only because of the extraordinary move that we got up to 0.7 on that slope value during this 30-day time frame. That was just a remarkable 30-day performance, and that slope value is among the best we've seen in the last 10 years. So we're still well above the zero line, which is this dotted line, and so this is still a very favorable looking slope value right now. Nothing to worry about there. Dark blue shaded area is the river. The thick red line in the middle is the Bollinger Band mean. That's a 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain. You can see how the market is now collapsing the volatility here now that that fun run is over. The dragon is the pink shaded region. That's the 10 period Bollinger Band plus or minus a half. It's been acting as support all the way up, continuing to do so now, swimming along the edge of the river. That's very healthy for the long term. So if we get any move above 208 here, then off we go. And I would expect to see another run like we see here and through this period here. We've stabilized pretty well with just that 1 day of pullback. You can see prices well above the 200 period moving average. It's the shaded red area. And the 10 period regression line and channel are the blue channel, and then the 30 period lag by a day is the black channel. Both slopes are positive. Both are in the favorable positions for more movement. They've stabilized pretty well over the last 5 days, failure to fail, and that's information. So again, we get a break above 208 and then off we go. Any sign of strength, and I am in the green zone, and I definitely want to be long. I wait in the yellow zone to see what the price action for the day is for intraday trading, but right now my bias is on the long side on the intraday. We've been overbought here for almost 40 days now, using Williams %R, and the only weakness in here is this is the PPO, which has the jaws open slightly to the downside. A lot of that is the consequence of this extraordinary run-up and just processing the data. So this is, for all practical purposes, flat and favorable. The ETF2 regional report, you can see that 6 out of the 10 are on buy signals, 4 on cash. That puts us at 60-40 relative strength for the market condition. The S&P at 72 is much better than the globals at 62. Inside the U.S., it's tech, large cap, mid cap, small cap. Two strongest sectors continues to be U.S. tech and large caps. Two weakest continues to be Latin America and Asia less Japan. Everything positive in the sector spiders with the exception of energy. The green just reflects just how strong the U.S. large caps have been across all the sectors. World market model showing based on relative strength, everything in the U.S. above average, tech is exceptionally so. Treasuries still strong, along with corporate bonds and real estate. Commodity complex suffering well below average. Everything Europe continues to be in the hurt locker, except for the Netherlands. India leading the way in Asia, less Japan. Japan is above average. Asia less Japan slightly below average. Mexico, Brazil, Latin America just getting crushed. Emerging markets slightly below average. The top 30 ETFs using that ETF2 model, all these that are green and white are things that are continuing to add relative strength compared to the rest of the database. So this is your long-term relative strength leaders. The ones that are green in strength and consistency are fully valued leaders and still running at the front of the pack, but they've been there for quite a while. That's how you read that. So healthcare is strong, along with biotech, health and biotech. So you can see that trend. This is the Dow 30 using that same lens. Early interest here in Goldman and Pfizer with green and white, but otherwise it's Nike, Visa, United Health, Intel, Home Depot up top. IBM suffering. Chevron is suffering because of the energy prices. I like United Tech at white and green, and strength is starting to come out of Johnson & Johnson a little bit in the white and green. Looking at the daily market report, a handful of channeling and overreaction, some good charts in Boeing for 5 days down and 551W, and then a ton of good ones for the auto framer, no signals in the overreaction or channeling. You can see in the Dow 30, we've got half a dozen of good frog candidates. The percent winners from Friday are in the green, the percent losers in the red. Some very good auto framer reward to risks, so Caterpillar, AT&T, Chevron really come to mind. No tactical signals from the patterns in ETF 30, but again, quite a few lining up very well in the auto framer. Oil just getting smoked, but it's at 6.5 to 1 on reward to risk. When that reverses, be ready. Small caps, financials, and the inverse volatility all did very well on Friday, and again, half a dozen good frog quality candidates. Only oil on the RSI2 signal with a score below 10. Plenty of auto framers to choose from, and you can see some relative strength winners down here in the bottom stack, and then the best value plays based on the difference between short-term price action and long-term fair value, which we treat as the 270. You can see in OIH, for example, that's 10.5 ATRs below its long-term regression line. And the rest of the chart's just for some reference material for you. You can see just how strong that that previous 30-day regression line slope was compared to the long-term average. Pretty amazing. Let me move back here to the signal to noise ratio. Just want you to notice that Latin America and Brazil are in this top green stack. And what that means is that they have been extremely trendy intraday. And so we take the real body of the candle divided by the range of the day to come up with a percentage. How much of this was signal, how much was noise. The fact that it's up around 0.58 just tells you most of the movement during the day has been directional, so that becomes a good candidate for frog-style trading. Looking at swing Z-scores, you can see the real strength in healthcare. Small caps actually doing pretty well, as are the large caps. And the Z-scores of the regression lines, the 90 continues to rise as this market just keeps motoring along. The 10 has pulled back to its long-term average, and the 30 is coming back towards normal. So this is all really very favorable. The 90 slope tells you that the longer-term trend has not really gotten ahead of itself yet. And so if you consider the last 5 days or so of the Thanksgiving holiday as being the pause that refreshes, both of those regression lines have come back to normal, and then failure to fail further puts us in a really good posture here at the edge of the river. Now, we're going to respect our stops because you can see in other places where it's ridden the river and it hasn't followed through, it's been followed by some sharp moves. So we want to preserve our profits, but also be poised for the next leg up. You can see back in this one where it went from 185 to 200, that was almost a 10% move in here. So we want to be open to possibilities on both sides. The fact that volatility is declining is a favorable thing. And that's everything I want to cover from the daily report. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.